Both Netflix and Disney have market capitalizations just over $200 billion. Both operate in the global film production and distribution industry, and both are considered revolutionary companies in their own respect. If you had made an investment in Disney at its IPO in 1957, your investment would have achieved a compound annual growth rate of 14% before including dividends. This means that $1,000 invested in Disney's IPO in 1957 would be worth approximately $4 million today. If you had invested in Netflix's IPO in 2002, your investment would have achieved a compound annual growth rate of 41%. This means that $1,000 invested in Netflix in 2002 would be worth approximately $500,000 today. Now, Netflix was actually the best performing stock in the S&P 500 from 2010 to the end of 2019. And they were able to achieve this growth by revolutionizing the way that we consume entertainment by introducing us to the streaming subscription model, of which they still remain the global leader. However, over a decade after Netflix has introduced us to this revolutionary model, the entertainment industry is catching up, and the streaming wars are heating up. So today in 2020, if you had to choose between investing in Netflix or Disney, which one presents the better investment opportunity? That is what we're going to be talking about in today's video, so let's get into it. So we're going to start things off by talking about Netflix. Netflix currently has a market capitalization of around $213 billion. They carry a price to sales ratio of 10.5, a forward price to earnings ratio of 60, and a price to normalized free cash flow ratio of 69. Now, based on historical standards, this would be considered an extremely high valuation for a company. However, Netflix's business model warrants such a high valuation. And this is the reason why. Netflix's revenues are highly predictable and stable. And this is completely opposite to what we have seen historically with entertainment companies. Generally, consumers are going to cut back their spending on entertainment during economic downturns, but given how affordable Netflix's service is, consumers are not likely to cancel their subscription to Netflix because most consumers can afford a $10 to $15 subscription to Netflix even during economic downturns. Now, this makes Netflix's future revenues highly predictable. And on top of that, future growth is highly likely for the company. This is because there are increasing adoption rates of streaming service technologies all across the world. And of the 2.2 million subscribers that Netflix added in the third quarter of 2020, only 200,000 of them came from the North American market. The remaining 2 million came from the rest of the world. And this showcases that there is high growth potential in the international markets and that Netflix is actively pursuing growth in those markets and doing so successfully. So this tells us two things: that Netflix's revenues are highly predictable and also highly likely to continue growing. This makes Netflix a rare breed of company that is both stable and high growth. The company's business model has made it very easy for analysts and investors to predict future revenue growth and also to predict future profitability for the company. And this has to be priced into the stock and is why it carries such a high valuation. Now, in addition to this, Netflix has been experiencing economies of scale throughout their business operations. The largest expense for the company is acquiring and producing content for their platform. You can find this represented in the company's income statement through the cost of sales. Currently, the cost of sales for Netflix is over 50% of the revenues. However, cost of sales as a percentage of revenues are likely going to be declining in the future. And the reason why is because Netflix is becoming increasingly efficient at allocating capital to the acquisition and production of new films. This is because Netflix is able to leverage all of the data that they're generating from their user base in order to only focus on the type of content that they know will retain and attract new users. For this reason, it is highly likely that Netflix's revenues are going to outpace the growth that we are going to see in the cost of sales for the company. And we are already starting to see evidence of that in their financial results. The company's operating profit margin has risen from 4% to 12% in the last 4 or 5 years. And this trend is likely going to continue into the future as the company becomes increasingly efficient at allocating capital to the production and acquisition of content for their platform. Now, while Netflix is a high growth company, has highly predictable revenues, and is experiencing vast improvements in the operational results of the business, there is one drawback to the company's business model that I want to touch on. And that is the fact that Netflix is only able to generate revenues through one revenue stream, and that is their subscription service. This is in comparison to other major entertainment companies like Disney, who is able to leverage the box office, is able to license their films out to broadcasting networks, and is also able to generate revenues through their own streaming services. So this is a limiting factor to Netflix's business when compared to a company like Disney or Sony, who have very strong distribution capabilities for their production studios. So now I want to quickly jump over to talking about Disney, looking at their valuation and business model the same way we just did with Netflix. Now Disney has a market capitalization of $230 billion compared to Netflix's $213. They have a forward price to earnings ratio of 50 compared to Netflix's 60. They have a price to sales ratio of 3 compared to Netflix's 9.8. And they have a price to normalized free cash flow ratio of 13 compared to Netflix's 69. Now what you should know about Disney's forward price to earnings ratio is that it jumped up significantly since last year when it was trading at 36 all the way up to 50 where it's trading now because of the impact of coronavirus, which significantly impacted Disney's operational results and will likely be impacting it for the next year or two, depending on the restrictions imposed on the company's business. Now, as I stated earlier, Disney has an incredibly powerful distribution network. They have an incredibly strong portfolio of media networks and broadcasting networks. In addition to that, they have very strong relationships with movie theaters. Now, in terms of media networks, Disney owns the Disney Channel, they own FX, they own Freeform, National Geographic, and ESPN. This provides them with very cheap access to distribution and allows them to also generate revenues from all these distribution networks by selling advertisements during commercial breaks. Now, the media network segment of the company's business is actually the second largest revenue producing segment, just behind Parks, Products, and Experiences. Now, this segment generates 30% gross operating profit margins, so it is an extremely profitable segment of the business, and it's exceptionally stable because people generally don't stop subscribing to their cable or satellite networks during economic downturns. However, advertising spending does tend to decline during economic downturns, so this segment still does experience some volatility during economic downturns. However, if we look at the most recent quarterly report, we'll see that revenues only declined by around $200 million in the media network segment, which represents less than 3% of the segment's revenues. So while it does experience some volatility, it's not really that great. The segment of the business that actually experiences the most volatility is the Parks, Products, and Experiences segment of the company's business, which saw a mind-boggling 90% decline in revenues during the most recent quarterly report. Revenues fell from $6.5 billion in Q2 of 2019 to just $983 million in Q2 of 2020. Now, clearly this was to be expected after the extensive restrictions that were put in place after COVID-19, and this is why Disney has not recovered as well as other companies, because they have very large exposure to Parks, Products, and Experiences segment of their business, which is doing extremely poorly. However, luckily for Disney, they have 4 segments to pick up the slack for them. Their media networks, as we said, did extremely well. Their production studio also took a bit of a hit, however, they still were able to generate positive operating profit margins for the quarter. Now, Studio Entertainment generates revenues from the sale of feature films produced by the company. Now, Disney has arguably the strongest production studio portfolio out of any entertainment company in the world. And they have been able to do this over the last 2 decades by pursuing an acquisition strategy. Over the last 2 decades, they've acquired Pixar, Marvel, Lucasfilms, and 20th Century Fox to add to their already incredibly strong in-house production studios with Disney Studios. Now, what this has done for Disney is increase the stability of revenues for the company, because in the past, the company used to go through small spells where they just wouldn't be able to produce a good movie for a few years or even sometimes as long as a decade. Now that they have so many successful production studios in their portfolio, they're able to consistently have at least one big box office hit for the year, which they can generate a lot of revenues from. Now, this also improved their relationship with a lot of theater owners, because theater owners also want to reduce their risk by putting the best movies into their theaters. And by developing a relationship with Disney, they're able to ensure that they have at least 1 or 2 good films every single year to put into their theaters. So by Disney improving their production studios, has been able to benefit from both increasing the revenue stability of their box office performance, and by improving their relationship with theaters. Now, as we know, in 2019, Disney released their Disney Plus streaming service. And while it's not as successful as Netflix as of yet, Disney also owns 66% of Hulu, and they also have their ESPN Plus streaming app, which is a streaming service for sports. Now, sports is an area where Netflix is not able to compete. So Disney does have a competitive advantage in their ability to provide more variety to their subscribers, and you can also purchase a bundle of Disney Plus, ESPN Plus, and Hulu Plus for just $12.99 a year. So I think that Disney streaming services have an incredibly good chance at experiencing high levels of growth, and potentially even higher than that of Netflix, because of the fact that they're able to offer more variety to their users. Now granted, Netflix's user experience is unparalleled and nobody in the industry has been able to match Netflix in terms of user experience. However, I think that it is highly likely that Disney is going to be able to catch up to them, or at least get close in terms of user experience, and also provide them with more variety. Disney's segment, Direct to Consumer International, is where Disney reports the operating results of their streaming services. And if you see, they haven't been profitable as of just yet. But in the long term, I think this is an excellent growth opportunity for Disney, and it showcases just how good Disney is able to adapt to changes in the entertainment industry. Disney has historically done this extremely well, as they've been around for 90 years, so clearly they've been able to stay relevant, and I think that they've done an excellent job in terms of staying relevant and staying on top of the streaming wars. Alright, so now let's get into talking about which one of these two stocks presents a better long-term investment opportunity as of today. Now, before we get into that, I want to quickly mention that both of these companies make excellent long-term investments if you're able to buy them at the correct price. What we're going to be looking at is how the market has valued both of these companies completely differently due to the effects of COVID-19. Netflix stock is up 50% year to date, whereas Disney stock is down around 12% year to date. This is because Netflix's business has actually benefited from seeing a massive boom in subscriber additions, which has led the market to aggressively pricing in future growth into Netflix's stock. So this means that the market is expecting future growth to continue at a more rapid pace due to the effects of COVID-19. This is in comparison to Disney's stock, which has fallen 12% year to date due to the fact that their Parks, Products, and Experiences segment has seen a 90% drop in revenues. Now, the market is pricing in the probability that COVID-19 is going to negatively affect this segment's operational results for the coming years. So if you're going to be buying Netflix, you're going to be buying into a stock that is currently being valued very optimistically by the market, compared to if you're going to be buying into Disney stock, which is currently being valued rather pessimistically by the market. So this is the basis for why I recommend buying Disney stock over Netflix stock currently, because if you're buying Netflix stock, you're going to be buying into a stock that is already priced very optimistically. So if the company misses on any of its growth targets, then your investment returns are going to be negatively affected. Whereas if you're going to be buying Disney stock, which is currently being priced pessimistically by the market, and they actually surpass the targets that they set out for the company, you're going to see improvements in the expected returns on your investment in Disney. And this is essentially the basis for my investment recommendation on Disney over Netflix. Now, I also ran a value of growth model for both companies, which gave me an intrinsic value per share for Disney of $157 per share, and an intrinsic value of $120 per share for Netflix. Now, the reason why this intrinsic value is so low for Netflix is because the value of growth model is a backwards-looking model where it applies a historical average operating profit to calculate the normalized operating cash flows that the company is going to be able to generate. Now, Netflix is seeing vast improvements in their operating profit margin. So what I did is I conducted some sensitivity in order to see what Netflix's valuation would be if they were able to consistently generate 25% operating profit margins compared to the 12% that they were able to achieve in 2019. And what I got was an intrinsic value of $225 per share. And this tells me that Netflix's stock is being priced extremely aggressively in today's market, and is another reason why I recommend buying Disney stock over Netflix stock. Thank you for watching this video. I hope you enjoyed and learned something new. As always, I'm not a financial advisor, but I do hope that you guys enjoyed and learned something new from this video, and I look forward to seeing you in my next video. Have a great week.